Felix here, and the 2023 stock market crash was promised and it's officially cancelled, at least for the moment. And why is that? And what does it mean? What are the key drivers here? Stick with me for a couple of minutes. I'll walk you through it. Of course, none of the following is financial advice. You know that by now. Be smart about it. Just some former investment banker here on YouTube trying to tell you a little bit about how he sees the market. Bad news is okay officially, and we have survived last week. Higher rates for longer from the Fed, the European Central Bank, the Bank of England. We survived pretty gnarly, nasty earnings from the tech majors. Falling order books from industry and manufacturing, and essentially a recession, and yes, some really, really dodgy looking jobs numbers, but they don't seem to matter very much. What else is good news? Well, expectations for earnings are for the year, according to Goldman Sachs, 0%. They're expecting 0% earnings growth this year and only 5% in 2024. What does that mean? Well, it's going to be really, really easy to beat earnings expectations. That's what that means. I think all major companies have sandbagged expectations for the year. So I think we're going to get some nice upside surprises, not in this round of earnings. This one's still miserable, but in the ones coming. Money printing is back. Yes, one of the reasons we have got enjoying this rally is money printing is back. Might seem bizarre. Anybody would still want to print money after this experiment in inflation, but there it is, bright and clear. And who is responsible for that? Let me give you a little clue. Does that make any sense? Japan, indeed. Well spotted. The Japanese central bank has been printing money that's, like it's going out of fashion. Only downside, the only thing that's a little out of whack still with this rally story is that valuations are unusually high considering how much interest rates have gone up. So our S&P forward multiples is here at, let me just draw a straight line. Not that straight here, are at about 18.5 times earnings. And that's pretty high on average. Typically, I mean, look at 2018, right? We went down to sort of the 15 range. That's a little unusual, but then there is so much money gushing around that might actually explain it. But there could be a lot more great news. It could get a lot better. And why is that? Inflows into equities, into stocks. This is stocks have been negative. 7 billion so far this year left the stock market. 119 billion went into money market funds, probably because they watched my YouTube on that, bond investment earlier in the year. That's probably not the explanation, but you know what I'm saying. Imagine if that changes. Well, it has. Yay, the party is here. Look at the 1st of February, 16 billion inflows into the stock market, and over the last 4 weeks, 44 billion. Yeah, we're still net negative because January was pretty nasty, but that's looking very, very positive, isn't it? What's going to happen for the rest of the week? Well, if you look at the options market here, essentially, this is always the chart I show you, right? And it looks a little confusing, but the magnet is $4,200 on the SPX. That's the S&P 500 index. We're kind of expecting that to sort of get suckered up to there and kind of stick around in that general range. The only downside risk that's there is those pesky options traders are going to be hedging. Why? Because buying puts is super, super cheap at the moment, like really, really cheap. That's historically over the last 2 years. You can see just how cheap that is. So it's very, very attractive to hedge. I always think it's a good idea to hedge. What happens when you hedge? Two things happen. One is the VIX, the fear index, goes up. And the second is the hedging flows. Well, they don't just increase volatility, but they tend to push the market down a little bit. So expect a little bit more volatility here. Now, all right, don't get mad, don't make money. Yeah, that's a nice sentence, isn't it? But essentially, I can be wrong on the direction of the market, and I've been horribly wrong on the direction of the market this year, but I can still make money because generally speaking, I don't take that into account very much. And again, on the trades I did on Friday, which was Apple, Google, Starbucks, I was wrong on direction, I think, on 2 out of 3. I haven't got a very good track record on that front. But you know what? We collected like near 100% maximum profit. So we collected $2,300 here on now 16 earnings trades. That's a 21% return on the small portfolio that I run for you guys publicly. Could you do these trades bigger? Yeah, of course you could. Could you do them 10 times bigger? Of course you could. Could you do them 100 times bigger? Of course you could. These are very, very liquid options. You want to learn how we do that and how we get money no matter whether we are right or wrong on direction, which is, I think, the wonderful thing. I really enjoy that. If you have a 5-figure pile of cash or stocks or bonds or something, then you, in theory, qualify our coaching program. Head over to felixschwenzer.org/coaching. Just book a call, read through the website, have a chat with us, ask us a gazillion questions. We're here to answer them. And if you are new to investing, then we have a course with 100 lessons that's pre-recorded, but you still get to watch me trade live every single week. And I think that's important, not just for transparency, but also to gain a bit more experience faster. And then there's also unlimited chat support on that one. But if you want to work with me and our investment banking coaches one-on-one directly, then the coaching program is probably the thing that's going to get you there faster. But as like I say, we also give you a huge amount of value on the course. So check it out. And yeah, happy weekend. I mean, looks pretty good, doesn't it, going into next week? Really, yeah, we have a few big earnings obviously coming up, PayPal and stuff like that. But given that we got Amazon and Apple and Microsoft and the really big boys out of the way, I don't think that's going to really move markets that much. We've had all the nasty data out already. It was all bad, and the market's like, we don't really mind. We're now conditioned that bad news is good news, and that seems to be the way to go. So I'm looking a little bit more optimistically at 2023, I must say. I appreciate you watching. I appreciate you if you made it this far, if you were to smash that like button, because it really is very important, really very important. It's a little boring, but it's very important. So thanks for that, and I hope to see you on the next one.